Here.
Okay, we got the signal. We are streaming, so we can start when you're ready, Frank.
Sweet. Well, let's do a roll call just to get started.
Frank Facciano,
I'm here.
Ron Heckman, Larry Hamburger,
Present.
Glenn Reedman,
Present.
Mike Stershik.
Here.
Oh, okay.
We have a quorum, Frank.
All right, excellent. Thank you. Well, welcome everybody to the April Finance Committee meeting and Pension Committee meeting. Is there any public comment before we get started?
We do not have any, sir.
All right. Well, then I guess we'll go right to the pension updates. We have Peter and John both here.
No Peter today. Peter's
Peter.
on retirement for the day.
So is it John then?
This John.
Correct, yep. Can everyone see me?
Take it away.
Is that good?
Yeah.
So there's two parts to the presentation on the DB side. We just wanted to give an executive summary of the plans, the markets, and then for the third part, we'll talk about the defined contribution plans. So the first bullet point right now, the average return on the plan over the last 5 years has roughly been, 8.9%. Why is that important? Your actuarial return is 7.5. As long as the plan is performing above 7.5, you're actually adding to your funding status. You're increasing it. And what does that mean? That means it's less contributions potentially that the airport has to make. That second bullet point, these numbers were provided by Peter. It's as of 2020. Both plans are over 100% funded. One was at 101, the other one's at 107. Just for frame of reference, 5-6 years ago, you were probably at 70% funded. And over that time period, three things have occurred to increase it. The markets have done really well. The authority you have put when you've had the cash, and this goes back 3 to 4 years, you put some additional contributions in above and beyond what was required. And then, just us having you in a position to take advantage of when the markets have gone up. The third bullet point is the goal was versus other peer groups like yourself to perform in the top 50% of similar plans out there. And in 2021, you were the top 40 percentile. Over the last 5 years, you're in the 30 to 35th percentile. So you are performing well against your peers. And this just isn't versus amateur investors. This is versus other professionally managed plans. The fourth bullet point: the plans are fully invested, fully diversified, various asset classes, large cap stocks, small cap, international, and high quality fixed income. What is that? The fifth bullet point: over half the plan assets are passive or in index funds, and that's in the high quality fixed income. So whenever you hear, hey, the bond market's doing this, you have almost 20 or 30% in there. And then on the large cap side, the S&P 500, the largest 500 stocks, you're passively invested in there. And this, what is that? The sixth one, almost all the fees that are associated with the plan are paid from the plan assets. So, and that gets embedded into that return figure at the top. And administratively, the very last bullet point, your assets for 10 plus years have been custodied at Wells Fargo. Wells Fargo sold their trust and institutional business to the Principal Group. It closed in February, just a couple months ago. So now, if you see Principal on any statements or reports, that is where the assets have transferred from Wells Fargo. We are meeting with Principal and just confirming everything's come over and everything's working as what we expected. The same people that covered you at Wells Fargo, that whole team got lifted up and was put at Principal Group. So there's been no changes in the personnel, just where the assets are custodied. Here, real quick about the market. I don't know how much people do follow the market, but the first quarter was really interesting. There was a lot of disparity between different sectors and asset classes in the market. Most people don't realize this, but small cap stocks and the technology stocks, we actually were in a bear market. A bear market is defined the correction of 20% or greater. And a lot of the names that got sold off were the technology that were associated with the COVID trade, COVID being over. And, Netflix, as when we did this report, was roughly down 38%. I don't know if anybody saw it yesterday. They were down another 20%. Zoom, which ran up because all of a sudden everybody was doing virtual conferences, they have sold off. Facebook, believe it or not, when you weren't at home on a Zoom call or watching Netflix, you were on Facebook. Their subscribership has fallen off as people come out of COVID. Peloton. And the other bottom three are sectors. And what it's showing is there were places to make money in the market. And the two in the middle, the financial utilities are more interest rate affiliated. There's been a rotation in the market into what's called value names, which is usually the financials, the utilities, because they can do better in a higher interest rate. And the last one is energy, and that's mostly due to what's going on in Russia. You guys are probably feeling it here with any type of diesel or airline fuel purchases. And the one thing about that, too, is the calendar for Europe is its friend. We're going into warmer months, and the energy demand is lower, than it is in the colder months. And they're actually running out, the inventories of energy over there is getting quite low. And so they have an incentive to get this thing, politically, militarily wrapped up by the fall. And right now, in our opinion, that's the only thing really holding the economy back. Just quickly through these bullet points, the S&P 500, it's not as overvalued as what people expect. Companies are still making a lot of money on a terms of earnings basis. As you probably are aware, the economy is back to full employment. We're at 4%, below 4%. We spiked up to over 10% during COVID. Monetary stimulus, the money of the government, is still a big factor. They are trimming it back, but there's still a ton of money going in. Inflation, they expect to help offset inflation, 5 to 6 interest rate hikes this year. We're already into one. We expect another one next month. And the last one is, or the second to the last, fixed income. This is something we haven't seen for many, many years. Is fixed income is actually underperforming equities on a negative basis. That fixed income is actually down more than stocks. And the last one, the commodity prices, this is the one that can really change the direction of the economy, is higher gasoline. Just take gasoline. If it stays in the economy for a long time, it actually will act as a tax on the economy. It's quite as simple. If you have your pickup truck and it usually costs you $50 to fill it, now it costs you $100 to fill it. That just means that's one less pizza, one less beer you're going to have on a monthly basis, and it just trickles through to the economy. So these higher, right now the economy can absorb it, but if high energy prices last for a while, could be an issue. This is just the S&P. This is just the valuation here. This is there a way to zoom? Yeah, there we go. All this is, and it's just the valuation measure, is that price earning the S&P is usually at 16.3. That's the 25-year average. Right now, we're at 19.46. And you can look at the calendar years at the bottom where the valuations were at various other sell-offs. You go back to 99, 2000, the tech bubble, 07, the financial crisis, even the COVID here in 2020. But what it's saying is we're still within one standard deviation of our average, so it's not overly valued here. This part here is just the unemployment rate, calendar years on the bottom, and the only thing that is probably relevant to you is this tick up, the blue line on the far right, which because of the labor shortage out there, people are having to pay more to attract talent. And if you look at that light blue line over history, in the last 3 or 4 months, that is one of the largest wage growth periods that we've seen. And there's a lot of people that left the workforce during COVID that haven't come back, and people that are trying to attract workers of all different backgrounds. You are paying more for that now. This here, real quick, this is the stimulus that the U.S. government has been putting into the market. It's going to peak this year. They're actually withdrawing it. They're doing it through higher interest rates, and they are buying less securities. But still, it's just gone from basically $130 billion a month that they're buying down to $115 billion. They're going to start shrinking it by roughly $15 to $20 billion at a time. But the amount of stimulus that we've seen, we talked about it last time, we've never seen anything like this in the market. And you might say, why are they buying MBSs and loans? That's just to allow banks to lend money. If banks didn't see the Fed behind them where they could make a loan and turn around and sell it to the Fed, they would get tighter on their credit underwriting, and the market kind of freezes. So the Fed's basically saying any loans that are made personal for a house or commercial, the Fed is willing to buy them. This is just inflation. It is, you can see on the far right, it is ticking up. It's not as crazy as what the headlines are saying. Whenever you see these numbers, like if you see the headline February 7.9, they're just taking 1 month in annualizing it out. We are in the opinion that we still transition. We do think actually inflation's kind of peaking out here, that by the end of the year it should come in, but only time will tell. This here is just the interest rates are still low. Now we get into the plans here. In the middle column is the union plan. September 30th, 2015, that was the value of the plan. Why then? That's when we came into the picture. Over this time period, if you put in all the money that you've contributed versus the benefit payments you've come out, you take the union plan, that nets out to roughly $780,000. Investment gains are roughly $3.6 million. Today, the market value as of March 31st for the union is $8 million. The non-union is $9 million. And those are the 2020 funding status, 107 and 101. Once Peter updates the numbers through year end, they're actually a little higher because last year the plans did 13.3%. The rate 7.5 is what we're trying to beat. But this year the plans are actually down 5%. So the funding status is going to increase a little bit. In the little box at the bottom, the last contributions you made were in October, and that's what was made to each plan. You usually do that every October, and those are in the dollar amounts that we commonly see.
Do we want to talk about the assumed rate of return now or wait till the end?
We'll give you a moment later.
Okay.
Yeah, this is just, whoops. If you want to kind of, these next two are just the cash flows coming in, like contribution, fourth quarter, $395, and then withdrawal, that is what goes out monthly to the retirees. And then the last column is just to net it out against one another. Okay, this is the asset allocation for the plan. If you go to the third column, it says target. That is in your investment policy statement that has been given to us to guide the decision in the market. So roughly 40% large cap, 5% small cap equities, 5% small growth, 10% international fixed income. And you can see where the plans are, the union and non-union. They're right on top of one another. There's just some variation due to cash flows. But roughly, your overall asset allocation it's 60-40, 60% equity, 40% fixed income. And that allocation has been chosen to meet the 7.5% return. We feel that is what is needed to meet that number. The performance figures are the same for both plan roughly. That blue line is net of fees, the light blue line. So over the 5 years, the 8.9 versus the target index of 9.1. There's 20 basis points, but most of that is due to fees. And like I said, in the market value column, like large cap, of the 8 million, 3.2 million is in index funds on the large cap side. If we go to, these are just the various asset classes. If you go here to 2,054,000, that's the other big index bucket. That is the fixed income. So roughly, 5 million of the $8 million is in index. Why is that important? Because you always know you're going to capture the market, and the cost of it is relatively cheap. It's 0.2 basis points, not 0.2%, but 0.002 base. And you can kind of see, we'll talk a little bit of expenses. This here is the performance chart. We came in around year 6, and each of these, so each square represents a quartile. So the higher you are to the top, you're in the top quartile. The line in the middle is the average. And like if you take it the 5-year number at 11.0, that 40 next to it means you're in the 40th percentile. So, you don't want to be the top, because you're taking on way too much risk. You don't know what people are doing, and obviously you don't want to be near the bottom. But this is exactly where we would expect you to be. So any number, the longer term number, the 7 to 10 year, it takes into account all the shorter term numbers. So usually the longer term numbers are more relevant. And just real quick, this is the fees, and like I said, these are the same investments in both plans. If you look at the far right, if we could scroll up just a little bit. So on a dollar weighted basis, this is how much you're paying for investment exposure, our services. And if you look at the bottom right, so roughly the whole plan between your investment product, our services, is being ran for 0.4%. And I know we've talked in the past, before we came in, I think it was due to why you guys did the RFP, that number was up over 1%. You know, it was closer to probably 1.2. And if you're saving 0.5% a year on 8 million bucks, it adds up because that's your savings you're experiencing every year. These next couple slides is if you just kind of want to know what's in the portfolio, what it looks like. You can just page through them. And this is on the fixed income side. The only takeaway is we don't take a lot of risk in the fixed income. When you do have fixed income, it's high quality. And why is that? So when the equity markets do turn around, you have this flight to safety, and that's what this is representing. This is a union plan. Non-union plan is exactly the same thing as a union plan. You can look through the slides. The performance, the allocation, everything's the same. If we want to go to the defined contribution, which is the second presentation, this is a new presentation. This was something that was implemented by you roughly. Well, it's been in progress for 3 years, but we finally moved the plan, we got it in place, and now this reporting is new and it's occurring for this meeting. Before it was only the DB plans, but if we go to the next slide, this is the defined contribution plan. All new retirees are going to have some exposure to this. You have 3 big plans, a 457B, 401A for the union, 401 for the non-union. All 3 plans are identical. They all have the same fund lineups. They're all being run similarly. Before, there was different investment options. It was just, they were just going different directions. Now everything's similar and, in our opinion, more efficient. That third bullet point, like the DB plan, in here, the participants at the airport, they have the ability to pick index funds or active management where they see fit. We don't run, we just provide the investment options. They build their own portfolio. And just the last two, with building your own portfolio, that balanced investment options. Previously, participants didn't have a balance option. So if they wanted to pick a portfolio that was similar to the DB plan, they really couldn't. Now, they can go put their money into a conservative fund, a moderate fund, or a growth fund, depending what they perceive their risk to be, and they get a diversified portfolio. Like the moderate fund is more like the DB plan, it's 60-40. The growth fund is usually meant for younger investors that has more equity exposure. And the very last point, this was a big consideration of why they were selected, Mission Square Retirement, is they have signed a participant education person to the authority. They come out, I think, what is it, Todd, 2 to 3 times a year?
Now it's available online.
Yeah, with COVID, it's been a little different. But they have somebody assigned, participants make individual meetings, and they can do some lunch and learns as needed on various topics, where before we didn't have a assigned person that was here with their sole purpose of providing participant education. Here are the values of the plan as of 3/31. You can see how long these plans have been around. They've been around for a while. And on the right is just the market values at various points. So roughly there's 5.5 million between the combined plans. Here, these are the investment options. If you want to see what the participants have for large cap exposure, small, international, those are the various investment options. And the goal here was if they want to index or get market participants, they have the ability. It also protects you by having these index options in there because nobody can say, hey, I couldn't get the market return at the authority. So by having the passive and active mixture, it allows the participant to build any type of portfolio they desire. Here, the only note, this is the dollar values at the plan in the investment options. And the one that really stands out is that Mission Square Plus Fund is halfway down. If you look to the far right, total is $2.2 million. So roughly half the participant assets are in that fund. What is that fund? It's a money market fund. Why is that a case? Because when an employee would sign up here, if they didn't know what to do, by default, they would be put into the money market fund. And a lot of time, the participants wouldn't go back and make a change. So now the qualified default investment option is the conservative fund, which is roughly 20% equities, 80% fixed income. And so if the participant doesn't make a decision, that is where they're going. And in our opinion, it provides them a better glide path for retirement than sitting there in cash. So thanks to Mission Square, we are seeing people rotate out of just having their investment funds in cash into some more of diversified portfolios. If you go through here, this is new reporting. Before, you would never see the performance of the various investment vehicles. Remember, these funds are the same options in all the plans. The only one in here that we have under a microscope is the T. Rowe Price Large Cap Growth. They are witnessing, after being many, many years of a tremendous outperformer, this is T. Rowe Price flagship fund. They have outperformed. They have made a change at the portfolio level. And it's just not as easy in the defined contribution to make a change because we got to notify the participants. Remember, this is in the participants plan, and we would have to remap it. So we had them in our office. I don't know what it was, Kyle, like 3 weeks ago, and we're watching them. They're on a watch list, but their longer term numbers are still hanging in there. But that is the only one that we kind of have under a microscope. Everything else is performing within expectations. These are the balanced funds. Everything's right where it should be. And last slide before we get any questions is here for the defined contribution, because this is the future retirement of the participants. And Todd's internal committee, this is what we have challenged ourselves with doing is continue the fiduciary oversight. We've increased it tremendously over the last 2 to 3 years. Continue to educate the employees on how to use the plan. Try, where appropriate, to diversify the participants from using the money market fund, and just have tight fiduciary standards around the operations. Yeah, everything from our perspective, the numbers have been good. Yes, the plan, the DB plan's down 5%. Who knows what's going to happen between now and year end? Yeah, the long-term numbers of everything remain strong. So those are my thoughts.
Thank you, John. Happy to see the defined contribution report, and really good to know that we're offering the education and the advice regarding what to do with your dollars. Do you know how many of the folks are taking advantage of the education?
Yeah, I'm guessing Todd would know, it's probably like 20 to 40 people show up per session. And another change that was made was as people sign up as new employees, there's being more of a introduction to the plan than what we've seen in the past, and that's helping people get on a better foot, as they become an employee.
Does anyone else have any questions for John?
I'll ask my annual question. Given now the performance over the last 4 months, to me, puts this issue back on the table. Over the last 5 years, markets performed strongly, so we're well in excess of 7.5%. I still think 7.5% assumed rate of return is too high.
Right.
And I've been bringing that point up 7 years now? Yeah, 7 years now. And I bring it up once a year at this discussion. Have you seen any organizations like ours taking that assumed rate of return down to 7.25% or even 7% to try to? Because I get very concerned about how much the markets run up. I think we're in for a longer bout of inflation than you think, based on what I've heard today. What impact that'll have. Once you get into a death spiral with those pension plans, it gets ugly quickly. Yeah. And I want to make sure that we don't have too high a rate of return assumed in there, so we don't get caught short. Obviously, we've got to make sure that the pension plans are funded, people get paid.
Yeah.
I get concerned about a protracted flat market, not necessarily down, but a flat market, what impact that'll have.
Yeah, so before we talk about the return assumption.
Yep.
So the liabilities in the plan have a duration associated with them that is affected by interest rates. So in pension land management, to calculate the liabilities, as rates go up, liabilities actually, go down. So if we go into high inflation, potentially it could help the liabilities on paper. It doesn't make you feel better, but it does. I would say most of the plans that we see are between 6 and 7.5, with most of them clustered around 7 and 7.5. And why does that occur? Because anytime you change that assumption, lower it, you increase the value of the liabilities.
Yep.
And, what I think the mentality of a lot of boards is, hey, let's take, the risk in the market over the next 5 to 10 years, try to meet the 7.5. If we don't meet it, then we have to make the contribution due to the underperformance. Whereas if we lower that rate today, say we lowered it to 6%, what does that mean? That means an immediate contribution, your contributions to the authority immediately increase. Also, and I know on, not GASB, that liability is also taken into account on your financial statements. So if all of a sudden the liability goes greater than the plan assets, say it's 8 million, now the liability is at 9.5, you have to put another 1.5 onto the plan. So the question is, do we think, that the allocation can exceed 7.5% going forward? Over a 2 to 3 year period, it's tough to say, but I do believe over the next 10 to 15 years that we are, this allocation structure going back in history, the 40s and 50s has done it. But on any given 1 year, like last year, the plan was up 13.3.
Yeah, it's always it's a tough time to have the conversation when you're exceeding it by such a large number.
Yes.
But the time to increase it is the time when you're making money.
Correct. Yeah.
So,
Yeah.
then all the other issues that you're talking about
Yeah.
go away.
I mean, as an investment manager, is it easier to beat a 6% bogey than 7? Absolutely. But changing it does run through the organization, and it is a bigger decision because usually the liability of the pension plans are some of the large, other than maybe some bond offering you guys might have. That's usually one of the biggest considerations out there. And I mean, like I said, anything can happen on a 1, 3 year, 4 year basis. But I do believe if we're sitting here 15 years, 10 years from now, can we do 7.5? I would think that is in the cards.
And the other thing I want to mention is, if we go to a lower number, we're mandated to increase our contributions.
Correct.
What we did this year,
The voluntary.
we actually increased our contributions. So as long as we're over 100% funded, we can use that to our advantage by not lowering our contributions, which is what we did last year. We said, hey, our contributions were X. We're going to stay at that level, even though actuarially we can lower those numbers. So we're actually putting in another $100,000 and some $1,000, almost $200,000 this year.
Yep.
Above our MMO. So,
This is not annual rebuttal where we manage it voluntarily so we don't have to force it upon ourselves.
Which right. Now, and the other piece of it too, and I don't know if you mentioned it, is we changed our contributions so that we're doing them quarterly. So that helps him out cash flow wise.
Sure.
So that way he doesn't have to dip into the fund to make some payments. So he has a little bit more cash. So that means he can invest more freely and hopefully earn a higher return.
Yeah, so 80% of the time, just using history, the plan would be positive because equities are higher. So by getting that money earlier in the first and second quarter, that money is, instead of getting it all, at once, it does help over the long run, the funding status. But in the years, when the market goes down, which is 20% of the time, it's, null and void,
Perhaps you get dollar cost average a little bit.
Yeah, it
Which
does.
helps.
It does.
Yeah.
Yeah. So I mean that is the voluntary that's a good way to think about it. You could have a 7.5, but manage it like a 6.5 or a 7, and if you have the excess funds available, make the contribution like you're running it at a 7%. Whereas if the money's not there and just make something crazy, we make it 6.5, then all of a sudden you're scrambling to find the money because you're required to make the
Yeah.
contribution.
No, and it's a valid rebuttal.
Yeah, yeah.
I've always acknowledged that.
But, I mean, you know, boards around the country, this is something they debate all the time. It's just, being required to make the contribution for, because anything could happen. Like, 2 years ago, I don't think anybody thought that the markets were gonna do what they did, 2020, especially COVID. We were down 20% in the markets at some point, and it ended up the year positive. Last year was up, 28% in the S&P. So, yeah, it's tough. It's an art,
That it is.
Yeah.
That it is.
All right. Well, thank you, John.
Yes.
Any other questions?
Yeah, I have a question. So you don't have any target date funds on the DC side at all?
Correct.
Right. And the default is which plan?
It's the Vanguard Conservative Fund. And so the target date, so target dates change their allocation as the year approaches. So today, if somebody's in their 20 and they pick, what would it be, 2050, the equity position's high. And as they approach retirement at 2050, the equity. Here, the funds we chose have a static allocation, whether it will stay constant at 60-40, 80-20, or 30-70. And the idea is just because you're getting older does not necessarily you always need lower risk, and so when you pick the target date funds, you're making sure that the fund manager is getting the investment right and the allocation right as somebody approaches retirement. And that was a big consideration when we sat around and we're looking at, a bunch of the funds.
No, I understand how
Yeah.
the target date funds
Yeah.
work, but is that the best for the employees to be in a conservative plan? If they're a younger employee, 20 years old, and they're in a conservative plan and they're
Yeah.
going to be in that plan for 40 years, the default should be a target date fund. Age appropriate, and also when you're going to withdraw the money.
So the plan can only have one default fund. And that's only,
Well, it can have a default fund based upon your age. A target date fund would be based upon your age.
right. So the default was the money market, right? And people were just going in there and they weren't looking at it. That was
That was the old plan.
the old plan. So and that's why all those funds were going in there. So our idea was, instead of just putting people in cash, because a lot of people were not coming back to their allocation and doing anything. And we felt they were being disserviced by not having any equity or pure fixed income exposure. So we identified one option. We replaced the money market with the conservative Vanguard.
I understand that, but based upon your age, that's not the best fund to be in.
Yeah.
I understand your point. Your point is a very good one, very, very valid, and it depends on the person's age. That's why we encourage the employee education, because it really depends on when that person starts here. We have people that start here when they're in their 40s. We don't have a lot of people that start here relatively in their 20s. So depending on that person and their circumstances, they can talk to that person and make a choice. The previous plan we had with Mass Mutual, they all went into the money market and nobody took the money out. So the first approach was, hey, let's put it into the conservative plan. This to kind of plateau there. And again, the education is there, so that person, the younger person, you're 100% right, should be much more invested in stock. But that investment person that they're talking to should be telling them to do that, and that's why we encourage the investment.
I understand, but there's a lot of, people don't understand what they're in, in investments and what to do.
That's
And sometimes, as the authority, we should take that responsibility on, and I'm assuming we're all fiduciaries. If we're fiduciaries, we should be putting them in the best plan for the employee.
Yeah.
I'm an advocate for target date funds for people that are not educated. Some
Yeah.
don't want to make the choice, and, for fiduciaries, we should be putting them into the best plan for them.
I mean, in our mind, when we were doing this, like in a theory, we didn't want anybody sticking into a qualified, that was only there if they didn't take an interest or attend participant education. We want them to be learning, in their journey with the education provided by the authority, where they can go in and help, maneuver, around the various asset classes. And, sit down with the professional from Mission Square you know, to do that. The qualified default, like, was just there to catch it if they didn't take any interest. And, you know, like, if we made it more risky, we felt like they could come back and say, hey, that was riskier than what I thought I was in. If we made it too conservative, I thought, you know, as the fiduciary, that like we weren't giving them the best option to meet their retirement goals. So I mean, that's where there's target date funds that they can be an option, and a lot of plans do them. But like I said, you're relying on the glide path of the product provider to get that right and the investments.
And the other thing is, we wanted to streamline the number of investments that we had.
Yeah.
I mean, we had so many investments before, because if you had target date funds, you gotta add a ton of them based on certain areas. So you would have to have one maybe 40 years, 30 years, 20 years, 10 years. And that's adding to the complexity of what we have here. So we tried to streamline it initially. I mean, your points are a good one. It's just, that's why we really focus on the education, because at the end of the day, the employees should be making the best choice for themselves based on their individual circumstances.
My bank rolled out, let me
No,
push you on this one, 'cause I think you're raising a good point. My bank rolled out target date retirement plans in our funds in our 401k about 4 years ago. We've got 60% of our fund assets in a short period of time went in target date retirement. People like that option because it manages it for you. My daughter's got her funds, her retirement funds in the Vanguard 2055 or 2060 plan. I forget which one. I think we need to consider adding the target date retirement funds. I understand your complexity point, but the target date fund set is for all intents and purposes, to me, it doesn't add complexity. It reduces complexity because it helps people target towards their retirement. But I think it's a valid point.
Well,
So as we talk about that, so is it thought that we add a few target funds and use one of them? Now, what you're saying is that each one of them, so say we pick up 4 target funds, and depending on the person's age, that would be the default based on which age they are.
right, so I mean, target date funds usually are 5 years, right, John?
Yeah.
I think.
Yeah, they're 5 years.
Yeah, you just pick 5 years, so you just pick 5 years, and that default, because what you're saying is, the default one right now, you're seeing people going into that but not coming out of that. So they're not actively managing their own money, right?
We were seeing that, and what the original was the alarm, they were going into money market and not getting out. That, and that's the way it was for many, many years, and we were sitting around as like, we gotta inch them out of cash and get them exposed in the market, and that's kind of where we went, yeah.
Absolutely.
And the other thing is, which is part of the reason that it's so high, we mapped, because the old plan that we have at Mass Mutual was all money market, so that was mapped. So we didn't take you out of there and put you in another fund. We just mapped you to another money market fund. So most of that money is old money that was there
Correct.
20 years ago, which, you know, and they're not moving, and we tried to encourage them to move it, but the newer people, I see your point, but
Yeah.
the people that were there. So your points are valid.
Yeah, let's take a look at
I'm
that.
an advocate for target date funds. Yeah.
I think we can look at that.
Yeah.
We can look into that. No,
The reason they never came out is because they didn't understand where to go. And they just let it ride. A lot of people we've talked to, they're happy for the plan, but what is it? What's it do? We've changed that a little bit now with these training sessions. I think it makes a difference. Do we have any idea what percentage of people do participate or do move after?
I'm sorry, yeah, I missed that stat. Do you have the stat of all the participants in each plan?
The number of
I
participants?
think he just has the dollars. I don't know. We have-
Usually you have a participant, they have 100% of their funds are in this plan, 20 participants or whatever.
Yeah, we don't, I mean, we have the number, we just didn't bring it.
But, I mean, that'd be a good number, because you could say, hey, there's 20 employees in this default that has 100% invested in a default, and they're not in anything else.
Yeah, like, when we were deconstructing it, there was 43 investment options in some of the plans,
43?
right?
That was the only.
It's a problem, though, that there's 43, and even,
But
how much education there
like,
is, you're not gonna pick up a plan.
but 95% of the assets were like 4 options,
Right.
5 options. And so so to your point, there was a lot of confusion. Participants
Absolutely.
didn't know what was going on. And with a big portion of that money being in the money market. So very few assets were actually outside of the money market fund within the 3 or 4 funds they were using. So that one chart where you see them spread out among the whole fund lineup, And, you know, that I believe is due to the Mission Square education, and when you are onboarding employees, there's more of a discussion going on. Hey, like, this is an important decision. This is your 401k. This is, you know, your investment options. And on the front end, I think it's helping too. So between the education, because there's now a market value balance in all the funds. So people are learning to build a diversified portfolio to use different investments.
And I don't think you're gonna see the percentage change, because again, most of the money that was there was in the fixed fund. So when we moved it over, only for new hires. So if you had your money there, we told you to do it, but people didn't wanna move it. They were always in that same fund before. But new folks obviously might go into the target.
See, we had time, when we rolled out the target funds at the bank, we had people that had been bank employees for 25 years roll into the target date funds. They liked that a lot. They really
We
did.
had some discussions about it, but
Yeah.
your points are well taken. I mean,
That's something we can
there's
certainly.
something we can roll in there, and then how many of these funds we want to
Yeah,
roll in
the fact of the
there.
matter is, my favorite thing is, you know, you should rebalance your portfolio every year. Nobody rebalances their portfolio every year. Target fund takes that
Take
off the
another-
table.
right,
It
another
makes it
one.
easier. And you can pick Vanguard, you can pick Fidelity. These are good names. They generate good results. The risk for us from a fiduciary perspective is very limited.
No, your points are well taken, so that's why we have these meetings, so it's good. Points.
Thank you.
All right, is that it?
Thank you, everybody. Very
Oh,
nice
Make sure Peter
engagement
includes
there
knocking it down to
in
7
that
quarters.
discussion.
Just for numbers in there.
Don't encourage.
Yeah, we're not going to 6, but.
Here's the. Thank you. Yeah, thank you.
Yep, thank you.
Thanks, John. All right, we're going to move to the,
Thanks, John.
Yep, thanks, guys.
Yeah, thank you.
everybody good?
Thank you.
Yep, yes. Thanks.
Approval of the March meeting minutes is next on the agenda.
So moved.
Glenn,
Hang out or not, we're doing a regular part.
Second.
and we have a second. All in favor?
Aye.
Oh,
Aye.
Aye.
Frank, I just realized I can't second. I'm not on this committee.
I thought you always.
I'll
Okay,
second.
then. Thank you.
You're not
Thanks,
all right.
Mike.
Yeah.
I got second. All right. Financial statements, Todd.
All right. I'll do what I can here. I guess I should get up into the John spot there.
Move. Colin's not here to yell at you, but.
Yeah, sure. Colin's not here to keep me in check. So, good to see everybody, no mask. Walk through our financials. So I wanted to start off with just the traffic as we always do. You know, this one is a little bit longer, so bear with me because we're at the end of a quarter, so it's always important to kind of focus on where we are at the end of the quarter, a little bit more than our usual monthly stuff. So I wanted to point out that through the first 3 months of 2022, we had our best first quarter ever with Allegiant. Best first quarter ever. Legacy carriers are pretty far behind. They're, you know, if you compare it to 2019, we're up 9% versus, or should I say 19% versus 2019 on Allegiant, and we're down 23%, and you can see the ones in green there on the legacy carriers. And this kind of seeing here what's going on with our traffic in general. So if you go back all the way to your left there, you'll see that in 2016, Allegiant was approximately 30% of our traffic. And then you can kind of see what's going on. And you see actually in March of this year, it is 51% of our traffic. And then kind of seeing what's going on. And a lot of the legacy shortfall is based on what's going on with business travel. So there's some optimism that number is going to improve. You can see here corporate ticket sales here. We pulled that stuff up here from the airline reporting stuff here. And then here talking about the money being spent and money spent in the travel on business. So, you know, versus 2019, this is overall. You're talking 25% less dollars spent. That's what they're projecting for 2022 versus 2019, and 20% less business trips in general. This is overall, just looking at our traffic, you can see there to your right there, 2022 is our third best quarter. And it might surprise people to know that even 2020 was our second best year because we were moving along, as you can see in that little green there, before COVID hit in 2020. We always compare ourselves to the benchmarking. You can see that our seats are up. Our seats are up 1.8, but our throughput is down some. So again, we have the seats, we just haven't picked up some traffic. But this is all airports throughput, and then you can see down at the bottom, all throughput is up 5.7, and the seats are down. So seats are up, throughput we're down, and that's throughput going through the checkpoint. And we always show our peer airports, so to kind of put us in perspective. We fortunately have all the names now, so Darren doesn't have to spout out which airport we're talking about, but we always focus on Scranton down there, AVP. You can see they're down 40% in throughput, and seats are down pretty significantly as well. You can see Harrisburg's down 20% there, MDT, and then they're down in seats as well. So, if you look at that average versus our peers, and this is the peers when we do our CPE and a lot of that stuff, you can see we're much better than them. And a lot of that, I think I mentioned earlier, is really attributed to our Allegiant crew base that we added literally February of 2020, right before COVID hit.
Why is Wilkes-Barre down so much?
They lost some significant service.
Did they?
They did.
Okay.
Delta's not restored service.
Just look at the month of March. Again, we always show with and without cares. March was an easy month because we didn't take any cares out for March. So you can see there we had 430,000 K, a good month. And actually that was the best month that we had net income wise of the first quarter without cares. And then you can see where we are year to date for the first quarter. Again, we're at 1.9, almost 1.9 million there, and over $1 million of that is from CARES. So you can see without CARES, it's about 813K. You can see some of that's based on our expenses, which I'll talk about a little bit more. Still down some on our parking versus our budget. We're hoping that that'll pick up, as we go into the summer months when traffic picks up, particularly on the leisure market.
I would imagine that's gaining pretty quickly. Everyone I talk to that comes over, parking's an adventure.
Recently, it's really picked up.
Yeah.
April, you see it, which is good stuff. So again, I will point out that I have returned to the top. Parking is on top there. So, you can see net income. That's where our money comes from, going down. You can even see number 10 there, which is always interesting. 9 and 10. I always say that airfield and terminal is supposed to break even, but a lot of stuff that we've done years ago, we didn't charge for certain infrastructure. And certain things are built into those numbers. So again, the top two kind of pay for some of the ones on the bottom there. And why we have such a dramatic number in our budgeted number? Again, it starts with those salaries. As remember, for people that haven't heard me say this about 1,000 times, we talked about our budget of integrity, where we budgeted these extra positions 1-1. Obviously, it's hard to get everybody on 1-1, but that'll help us as we go into next year's budget, so hopefully it won't be as much of a delta because the positions were there and not part of the year. So we built them in the full year, not half the year or whatever, but you'll see that as we go on. So that's the biggest number. So that 813 without cares would obviously be only 200,000 if we had all the positions filled that we had in our budget as of 1-1.
How many open positions do we have right now?
We have somewhere about 40, somewhere about that 40-some positions available. And again, it's more in the FTEs, which I'll talk about now, because you can fulfill it with more hours for different people. A lot of that when we put in our numbers is we might put in 3 part-time people working 15 hours, but that might actually end up being 1 full-time person. It's just kind of the nature of the beast. This is the FTEs. I mean, you prompted things, John. I'm going to hire you to just be my prompt guy from now on. But you can see what's kind of going on. This is our FTEs. We had that budget, and you can see that number steady at 226 is what we budgeted for the first quarter of FTEs. And FTEs, it's a little higher for the firefighters because of the way their schedule is. They have a little bit more hours. But for everybody else, it's pretty much 40 hours a week. So that could be 2 part-timers working 20 hours, two working 20, or 1 person working 40. So we had 226 budgeted. We have 192 in January. You can see we're up to 197 in March. So things are, improving somewhat as we go into some of our more busy seasons. Wanted to point out, we did this at the end of the last quarter, and it's always important to think about this from a quarter perspective. So, and this to kind of put things in perspective. So operational income, and an operational income is the income before we get into the accounting terms of depreciation and non-operating stuff, the infrastructure stuff. But the yellow is where we are. If you look back, and all these numbers are apples to apples, so there's no cares in any of these numbers. So you can see for the first quarter, we're at 2.2 and change, and look at that number from last year. That was the worst quarter, awful, 676, and then you can see our best number down there was in 2017, almost 2.4 million. The number there for 2022, for the rest of the year, is just kind of what we have budgeted. We don't care. Obviously, that's just a budgeted number, but just to kind of give you a feel for where we are. And you can see kind of that best number. Again, look at that number for 2021. That was our best number from April through December in that time period there. And you can see that was 7.2 million. So as awful as the first quarter was, we really picked it up the last 3 quarters of the year. And you can see in 2020, when you really started to, so really what you're seeing is that year period of COVID was just awful. The second, third, and fourth quarter of 2020, and then the first quarter of 2021, all red because of COVID. And then you can see our best year, a full year, was 2019, 8.2, followed closely by 18 and 17. But you can see for the last 12 months, so if you go back from April 1st through March 31st, we're at 9.5. So that's a good number. And that's kind of the number we're going to need to be at. We're kind of averaging these $8 million. And again, what do we do with the operational income? That's what we pay for our infrastructure. So, a lot of those numbers will be for the terminal connector. And every time we go out, we have more needs. Steve's always telling me all things we need. Glenn's always saying, our infrastructure is old, dated, so we're trying to update that, and that's how we pay for that money. It's not that it goes in anybody's pocket. We certainly don't have shareholders. But as we increase our leverage with the connector and other projects as we try to upgrade, that's important. And the other part to factor in there is we haven't had all those positions that we had in there, so that number's obviously going to go down once we get to where we want to be as far as staffing. And then we go to our cash flow, the yellow items there, talking about the debt service. Some of that is somewhat of a guess on when we think we're going to draw some of those monies, particularly down there on line 13. This is a reimbursement up until next year on some of our projects, so that's our best estimate at this point. And that obviously our debt service is going to be impacted by whenever we draw some of that money back.
Not to get ahead of ourselves, but we're still on track on the connector project?
Yep. Cash flow, again, we want to remain above 60 days cash on hand after contingencies and reserves. You see it here for 6 months. We're above, lowest number is 190. And if you go out 12 months, we started March there is where we are. We're at 217 at the end of March. And then you go to next March, we're estimating 182. But we stay above almost more than double that 60 days cash on hand, which again gives us breathing room so that if something unforeseen happens, we've got some available cash for us. And again, that 59,000, for people who haven't seen it, is what we need per day to run our operations if there was no revenue. Any questions? I think that's it. Yes?
When's the last time we were even close to having 226 employees? Because I came in during COVID, so I don't, obviously there's less people. Just out of curiosity. I
think it was right maybe 2020 Monday?
probably right before.
Right before COVID, we
We
were,
were at that number.
yeah, we were right above, right before then, yes, we were. Because actually, I go through this every pay period, I go through this stuff, and I sent it to Tom, I'm like, hey, look, this is the highest time period. Oh, yeah, that was right before COVID. So,
Are we seeing people taking jobs now?
yeah, I think we are. I mean, things are getting a little bit better than they were before. Obviously, it's a challenge, just like everybody everywhere else, but, I think if you look around at certain positions we're struggling to get, it's just, I mean, in a day where people want to work from home and some of those things, we're an operation, so you can't, some jobs you just can't work from home. It's just the nature of the beast. So, but.
Well, to that point, which positions do we have trouble filling?
I mean, most of our positions are going to be, they're across the board. I can't even say.
Okay,
one.
it's just not like, hey, this is one area where.
No, there's some of them, but, some areas we struggle a little bit more. I mean, certainly in the FBO, we've been struggling to keep folks in there. But some of the other folks, all across the board, we lose them. We need them in accounting. We need them in HR. We need them in passenger services. We need them in airline services. There's not a department, there should be a few departments, but most departments need more people. So it's across the board. But again, and one of the things that's challenging for us, and you were at the chamber event, congratulations again, is, they talked about that market value, the minimum wage of being at 20, based on what's going on with the, warehousing. We're in a different animal. We're not a factory. So in our jobs, which, you see people gravitate that, we have people that are here, these jobs are kind of hot and cold. So you have a lot of downtime in a lot of these jobs. So when they're busy, they're busy. So, these people make good money while they're working, but then they kind of just hanging out until they're busy. If we could kind of space it out, we would be in a much better position to give them a lot more money. Unfortunately, it's kind of peaks and valleys. So that's where we're different than somebody that works in warehouse. We're in the assembly line, got to ask for permission to go to the bathroom. Somebody's watching all the time. It's like you go and then you're kind of hanging out until people come. It's just the nature of the beast where we are. That's part of the reason we have so many part-timers, because it's hard sometimes to find a straight shift where there's a lot of activity. So that's our challenge, and we are 24/7.
Is there any opportunity for cross-training with any of these people?
I think we do it, but again, it's, we have certain niches of people that like to work. I mean, a lot of people love the airport. They just like the airport environment. We have a lot of people that are semi-retired that like to work here because of our part-time status, and they just like being around people and getting out. And then we have, I think, if we can attract some younger people, I think these jobs are great for college students because of that downtime. Because think about it, you could do your schoolwork and everything during the downtime and work and then go party later on. But it's just kind of communicating that to folks. So, not like you're sitting there all day, hey, I did my homework, everything, then I can go have a good time and I got paid for it. So.
Have your recruitment efforts gotten better since the beginning of the year? What have you guys seen?
I think they're steady. We don't have any issues recruiting people,
Okay.
Or benefits and wages are compensated, so we don't have that, we don't see that issue.
Mm-hmm. Okay. We did, and the other bankers that I talked to, the teller and CSR positions were really tough to fill. And all of us now are outside banks. I mean, I'm hiring people out of Borders Books and Weiss and places where I ordinarily wouldn't have looked for employees, and that's worked. But we've had to change how we do things.
Just kind of curious, you talked about college students. You have like a summer program for college kids?
I
I shouldn't say kids, but
I know.
college kids.
I'll let Connie chime in on some of the things we're talking about.
Oh, yeah, we're working with about 6 students right now, so we do hire seasonal. And then we work with them throughout their, 4-year college program, or, for example, we'll train them this summer, they'll come back Thanksgiving a little bit, then they'll come back Christmas, and they'll come back on their spring break, hopefully. So, yeah, we work with quite a few. We have 2 right now. I think they'll be seniors this year. They've been with us a few years.
That's awesome.
And we're also going to start working with career builders and I'll work with them with students, local students at all the high schools for this summer. It's an 8-week program. So we're we're looking everywhere.
And we've done that in the past, where we brought in some high school kids, we did some mentoring, and then hopefully they kind of build a relationship with us all the way through, and then they go to college and then hopefully come back.
Yeah, same with us, we have a summer helper program.
Right.
Kids out of OTEC, and, you know, and if they like the construction, they stay with us. If not, it's a scared straight program. But,
To Connie's credit, for years, we've had this program going on. We've had people become pilots, administrators, engineers, all kinds of folks that have worked and gone through it. So it's worked well. I think we have more people now than ever before, though, right?
We do. We have more passengers.
Well, and winter is tough, I will say, you know, some of the positions when you're hiring in the wintertime, it's an outdoor environment, and people come in and get exposed to the elements, and that's part of the job outside on the airfield, and, you know, we do lose people every year in the winter, just because that they weren't ready for that.
First big storm every year.
Yeah.
Expect at least a couple people not to show up the next day, you know?
Nothing like being in a bucket truck with de-icing fluid
All over you, yeah, it's a great smell.
Any other questions?
Any other questions?
All right.
I'll move to accept the financial report.
Thank you. Second?
Second.
Thank you. All in favor?
Aye.
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 Financial statements are accepted. Thank you very much. We have a discussion about the audit update coming up here.
Oh, I guess I gotta get back up. I was all seated and comfortable. Yeah, I mean, this quick, no problems. They were here for their field work. When were they here, Karen? I'm trying to think.
The end of March.
End of March. Things are moving along. We have our draft, and hopefully we'll be sending that to them, final draft, sent to them this week. I want to acknowledge our finance team, as always, for the great job they do. I know you know Karen over there. Wave to everybody, Karen. And we have Shane, who's kind of like Karen's new right-hand man. So, but yeah, we're on course, and we expect to have that next month. I'm assuming that we'll have the auditors in for our committee meetings next month, and then they'll be on the phone for the board meeting in case there's any questions.
Any material adjustments?
At this point, no. I mean, you know, we don't know of any at this point. It's okay. Like I said, everything's going along, no problems with the field work. You know, no news. You hope it's good news, but you never know. So, true. All right. Thank you.
All right. Well, thank you. Is there any new business?
I don't think so, Frank.
Hearing none, then get a call for an adjournment.
So moved, Frank.
Thanks, Glenn. We're adjourned. Thanks, everybody. Great discussions today.
Thank you, Frank.
Now I gotta go.
Okay.
All right. Sorry, we'll go ahead and get started. Welcome to the April 21st Lehigh Northampton Airport Authority Business Committee. So that, can you take a roll call, please?
Yes, sir. Trustee Grimshaw,
Present.
James Irwin,
Here.
Jeff Matskin, Chris Worley, Tara Zirinsky. We do not have a quorum.
Meeting adjourned. We'll run through it and I guess still talk. We just won't be able to approve anything. We'll just
Make recommendations
Yeah,
to the
we'll
board.
make recommendation, approve at the board. So we'll kick the minutes to next month. So we'll start with the approval of the Braden Airport Management Agreement System with Spirit Wings. It's gonna be about $8,000 a month, and I'll let Darren explain why.
Thank you, sir. So we talked about this a few months ago. We've been working with Spirit Wings, our maintenance provider down at Braden. Some of you probably know, those that don't, we haven't had staff physically at Braden since August of last year on a regular basis. We've obviously had staff in and out, checking things, but Spirit Wings has kind of been helping us out on sort of an ad hoc basis down there since then. Really, that just comes back to what we were just talking about, attracting and keeping staff. So the folks that we had a couple people down there that we actually had moved up to Queen City. So trying to keep that one staffed and keep ABE operations staff as much as we can. So we've been working with Spirit Wings on an agreement to basically take over the day-to-day operations down there. We feel like we came to a pretty good, a good agreement works for both of us. It's an $8,000 a month management fee that we're gonna be paying them. Basically saves us about $35,000 over what we had budgeted on the labor side for Braden. So it's a little less than we had budgeted. Like I said, I think service-wise, I don't think the customers will see anything different, if actually maybe better at this point in time, just because he is there all the time. Their staff, they've got folks on site, on site. So, and the things they'll be doing, you can see basically just the routine day-to-day things, including, moving aircraft, the grass cutting, snow removal, house cleaning, safety inspections. We'll train them to do the field inspections. We'll train them to do the fuel quality control checks, and obviously we're going to be monitoring all of that as well. They'll be staffing the new terminal 5 days a week, and they'll have someone at the airport on weekends as well, which again, we haven't done 7 days a week in quite a while just because of staffing constraints. So again, I think it's a good deal for both organizations. We're going to do it on a 6-month basis to see, that way if things don't work well, or for either one of us, basically, we're only kind of tied to this for 6 months with 6-month automatic renewing terms. So if in 5 months from now we're saying this isn't working for us, we'll terminate it and figure out what the kind of plan C is, I guess, at that point in time. But I feel like it'll be good for us. Like I said, I really think they've been kind of doing a lot of the stuff for us on an ad hoc basis, where we're just sort of paying them as needed up until now. But this will be better. It'll be just more steady coverage down there like we should have. So happy to answer any questions.
I guess my question is, there won't be any employees then from Lehigh Valley down there?
Not on a regular basis. We have an operations manager who kind of oversees the operations at Queen City and Braden. She will definitely be, she's doing it now. She's down there, probably a day or two a week, at least in for a little bit, and she'll be doing that. And she'll be working directly with these folks, so they'll kind of report.
But all the other positions at Braden will be outsourced?
Yeah, and like I said, what we had done basically, we only ever had a few positions down there. Those folks moved up to Queen City because we just did not have staff at Queen City. So there were 2 people working there whenever we decided to stop staffing it, and they're both still at Queen City at this point.
Okay, the good thing is it's only for 6 months, an automatic renewal, and either party can terminate.
Yeah.
How many days' notice?
I think it's a 30-day notice on termination that we put on there.
That's reasonable.
Yeah, so we want to make sure I wouldn't lock it in any longer than that, just because we haven't done it. So we want to make sure it works for us. And I think Dave DeSilva, the owner of Spirit Wings, was kind of in that same mindset. Like, he thinks, we all think it should make sense, but let's be sure.
Yeah. Can you explain a little bit, because I know the airport has worked with Spirit Wings on a case-by-case basis before, so explain the relationship that's already with the airport and Spirit Wings.
Yeah, basically what he's been doing for us for the most part, we have been doing the snow removal and those types of things. What he's been doing for the most part now is just mostly the aircraft movements and things. We have aircraft in bulk hangars down there, so if someone needs their aircraft out, instead of us having to run somebody down there just to do that, he's been doing those types of things. And honestly, he's come in some after hours and weekends and things, even though we hadn't asked him to, basically, kind of done that. And we pay him on an as movement basis for those types of things. But we just haven't had, right now, if you walk down there to go to the terminal building, the doors are probably locked right now because we don't have staff to be there to greet somebody, to see new folks coming in, So it's just, again, I think this is just gonna be better. Even talking to the GA community for the last several years, they've talked about this, like we should really have an FBO down there, not necessarily the authority. They feel like that's a better way to see it, kind of grow and everything. And he's pretty entrenched in the GA community, so I think he may be able to help us increase business there and things as well.
Is Spirit Wings local?
Yeah, I mean, they started basically
Did they?
at Braden, when they came in. Dave DeSilva's been in the industry for many years in lots of different places around the industry. He started this business himself, him and a partner, to start the maintenance business down there back in, I think it was 2018. They've done well. They've done actually really well. He's looking to take on some more hangar space for his business because he's growing and doing well with it, so.
Things mentioned 5 days a week. Is that assumption that they're closed on the weekends?
No, we just said we want someone basically kind of manning the terminal building 5 days a week. They will have staff there on the weekends as well to help with aircraft movements and things, but they may not have someone, maybe not someone answering the phones and things in the terminal every day, everything. Because I think it just doesn't, it's hard to pay someone for the amount of business that walks through the front door and the amount of phone calls to actually pay someone to sit there 8 hours a day to do that. So it's just a matter of how they work that. Probably the same way we've worked it, where, they'll forward phones off to a cell phone or something when they're not there, and we'll put some signage in the terminal that says, call for assistance type of thing, which is what we did when our guys were there as well, when they're out on the field mowing or whatever else they're doing.
When you do the math, you're looking at about a $60,000 increase in annual expenses. Why was the budget number so low? It seems $35,000 to do all of that seems low.
It's 35,000 less than we had the labor costs, so that's what,
Like,
so,
less-
so we had,
That's just the net savings, I think he's saying.
yeah, that's the net over, so when we looked at.
Savings is not the total cost. A lot of the labor.
Oh, okay. I read that to mean that the budgeted number,
What
yeah.
universe?
No, that's why I'm asking the
Yeah,
question.
he's nervous there. No wonder you got all these folks at the bank.
No, it's basically, yeah, it's basically, it's $35,000 less expense than what we
Okay.
had, had budgeted, that's all.
Okay.
The difference between what we're paying him and what we were budgeting for labor,
So we had 135 budgeted, it's gonna cost us 100.
basically. Any other questions?
Any other questions?
All right, thank you.
We'll discuss it at the full board meeting. Ryan, you might as well go plant yourself up there. Sure. You're gonna be up there for a while now.
So, yeah, I gotta.
We'll start with another action item that we'll just discuss today and then move to the full board for the approval of the runway safe for the bed repair.
Great, all right, thanks, Justin. Yeah, so, well, we talked a little bit about this when we got our budget approval back last year on our CIP, but what we're looking to do is work with Runway Safe, Inc. to provide the steam seal maintenance and strength testing required for our EMAS bed. So just a brief history, our EMAS bed is an engineered material resting system that was installed on the ends of 1331 back in 2015 when the FAA mandated our runway safety area compliance. So when we did that, the blocks themselves, it's basically like a crushable concrete, so if an aircraft does an overrun, it doesn't go outside of the airport or outside of the runway safety area. So it was mandated by the FAA. We put them in based on what was required. They have a 20-year service life, but every 5 years you have to look at preventative maintenance to maintain that service life. So the way they were originally done, they're basically these blocks on the end of the runway. They're basically put together by these seam seal tape that they had put in at the time back in 2015. Currently on both beds, there's some cracking and some splitting in some of the areas, and really what that does is it gets water in, which can degrade the strength of the beds because it's that kind of crushable concrete. So we really don't want water to get in there. So really what's done now is a repair that's very similar to like a joint, concrete joint repair with a backer rod and the sealant. So if you want to scroll down a little bit. So really what we're looking to do, so we put in the budget to do one bed a year. So this approval is for the way the FAA designates it is the runway 31 departure end, or it's the physical runway 13 on Ray Street near the large retaining wall there. You can see the breakdown of the costs. Like I said, it was in our budget for $400,000. Based on the pricing now, it's over that by $44,000, which is why we're bringing it to the board for approval. Really, the one thing, and we did have a conversation with the judge and the solicitor on this, is Runway Safe, Inc., through the requirements of what the FAA has in their advisory circulars, they're the only company that's certified to do the maintenance, the installation, the design, everything associated with it. So, again, we're looking to enter into contract with them, not seeking competitive bids due to the fact that they're the only enterprise that meets those standards. Again, we're looking to do this now, get the approval this month. It's about 8 weeks to schedule the repair, and then it takes about 3 to 4 weeks to do the seal replacement as well as the strength testing as part of it. So we're looking for, they approve the proposals and enter into an agreement with Runway Safe for $444,234. Does anyone have any questions?
How do we know they're the only company that can do it?
FAA says so.
Yeah, there's actually a letter attached to Novus that they basically, from the FAA, basically stating they're the only ones that do it, unfortunately.
It is pretty rare that the FAA doesn't have multiple vendors or multiple suppliers that can provide these services, and this is one of the things. starting way back in 15, when we were installing the beds, there was one vendor we could use, and it's really odd, but they were the only vendor
No one
across the
else is coming
country
to the market, yeah.
that could come to the market and provide that solution. So it continues to be the case. You know, and again, there's not a lot of demand, as Ryan mentioned, a lot of the safety areas around the country for runways had to be repaired by the end of 2015. There's not a lot of demand for new bed installations at this point. So, you know, you're really looking at the PM service at this point on a lot of beds.
Yeah, and I may have mentioned this, what we're looking to do is include the 31 physical end next year in our CIP, so we'll, you know, come back with a similar approval based on what the numbers are, the budget. So that's it.
Any other questions? All right, we'll discuss that next week then. Full board. Yeah,
Don't worry, I'm not going anywhere.
Don't go anywhere. We'll move on to the discussion items, and we'll start with Ryan for the capital.
Thanks, Justin. That's good. So a little bit in terms of our updates this month, really focusing on runway 624. I'll just kind of go through some of these, you know, quick in terms of what we're doing. But different packages actually starting up again. The paving next week, Monday, weather permitting, kind of getting out of the winter shutdown. Again, going back to those nightly closures, 11 p.m. to 5:30 a.m., working around the airline schedules. I'll kind of show what areas they'll be working on, but they'll be paving the midfield west section of the runway. Package 2, really all that's left here is we're waiting on the FAA to do their PAPI flight check, which is part of one of the navigational aids for pilots landing on the runway. And then they're finishing up some of the runway lighting installation for the runway centerline lighting, which should be completed around June timeframe. Package 3, again, still working at night. But the biggest thing with them is once all the paving is complete, they'll do the permanent markings along the entire length of the runway, so it's a nice clean look based on the requirements that are put in with the FAA paint specifications.
How are the closings at 11 o'clock working? I've heard we've had some flights coming in after 11.
There have been a little, so when we're not working in the intersection, which now we're on the 624, 1331 is still open.
Okay.
So we have had, you know, carriers able to use that. With some of the work we were doing the last few months, we've been able to pull off the runway if needed because of some of the light installation. But when we get to paving, we can't necessarily do that. But I think we have a call this afternoon with them to keep talking through the impacts, let us know what their schedules are, so there's no you know, concerns there.
Okay.
So package 4, they'll be starting up here in the next few weeks as well. So what they're working on is, you know, kind of this red area here, as well as continuing the taxiway echo work that they were doing last year. And then later this year, they're going to be working on this taxiway Gulf relocation that was in that contract as well. One thing to note in the next few months we'll be talking about with committees is the Package 5 grant application was submitted earlier this month based on the FAA's deadline. Open bids April 4th. The grant application that was submitted based on what the FAA had programmed was about $14 million. So we're looking again to come back to the board for the bid award and the grant acceptance. We're anticipating somewhere around June of getting that grant from the FAA. And just kind of looking at, you know, taking all the packages together, what are we actually doing this year? Basically, along the edges of the runway, you have the under drain for the shoulders. Package 5 is going to be actual shoulder construction along the end of the runway. You can see some of the taxiway echo work, both ends of the runway, the blast pads reconstruction, as well as construction that we're creating. And then you can see kind of down at the bottom some of the closure windows duration. So kind of back to another summer of nightly runway work. And the other projects will go through in the GA update, but here's kind of our summary that we've had. You can see kind of the percentage complete on the side. Everything's looking pretty good in terms of the pricing of where we are. You know, and even some of the expenditures to date, again, with some of the runway packages 1, 2, and 3, they're getting close to being getting ready to be closed out once they finish the work here in the spring. I believe that's it on this. Anyone have any questions?
move on to the general aviation update. That'll be Ryan. I saw Colin on Zoom if he wants to help you out, and Darren's sitting here, so
Appreciate it.
you want to pass it off, go ahead.
Appreciate it. That sounds good. So I go through some of this here. It's gonna work. There's that. Oh, it's working. Just click on it. Yeah, it's not working.
Do the power,
Right.
do the power. There you go.
All right, thanks. All right, so down to Queen City, we've been working on the runway rehab 1533 design over the last year. We submitted a grant application for this, also on April 11th. This is for the phase 1 work, which is just the pavement next year, with phase 2 is the lighting based on the FAA's funding cycle breakdown. Again, total grant application for this paving was $2.2 million. Again, going to come back to the board with the bid award and grant acceptance. We're anticipating in June this year. Really what the phase 1 entails, I mean, it's all the pavement, but it's what you can see in red down 1533, this section, the end of 33, and then it actually includes taxiway Baracco as well, which is in pretty rough shape that we're looking to do as part of it. So more to come on that when we get the grant application and then timing for the grant acceptance. Moving on, Braden Air Park, a lot of movement here. We talked a little bit last month in terms of where we are, but just some updates in terms of anticipating a late summer this year project completion. Really what they're doing this week, you can kind of see in the photos, is forming up the sidewalks. We're working on the fencing. Actually, so my team is there this morning doing kind of a pre-final walkthrough within the space. But really you can kind of see what we're really doing this month into May. The biggest thing is relocating all of the terminal or all of the furniture that's in the existing terminal into the new space, and then coordinating with the trail, basically the terminal that we're in now, which was rented, the company to come in and remove it from the site in order to do the rest of the work. So they're looking to get that out of here May 16th, which is good. So we've been coordinating with some of that movement. And then you can kind of see basically in June and July is looking to do a lot of the parking lot work, as well as the front portico, rear awning, and just some of the other site work cleanup based on what they're doing. And you can see just some photos during the construction when they got the site ready for the buildings, putting some of the utility work, connecting to the sanitary sewer. These were the units coming on site, then placing them on the foundations, getting them all set up on the site. And I believe that's it. I guess I will, Colin, if you want to mention, I think the GA today is the next. When's the next one coming out? A few months, I think, right?
Yeah, Ryan, we'll provide a GA today to the GA community coming up in June, which will highlight, obviously, the progress with the Braden Air Park and then any possible grant acceptance and the projects, which has been effective and a good information tool for the GA community. So we're looking forward to pushing that out in June.
Great. Yes, I think that's all I had.
Any questions? All right, thank you, Ryan.
Great, thank you.
Any new business? All right, I'd ask for a motion to adjourn, but I don't think we can actually vote on it, so we'll just move on. Jimmy, thanks for coming today.
We take 5 minutes and then we'll jump in.
Sure.
Zach?
Why don't we take a quick break and we'll jump. 1 minute? Okay.
Okay, thank you. I will go first to Matt Turk. I see he's on remotely. Matt, do you want to chair this meeting or would you like me to?
I think it's probably best that you chair. I'm going to spare you all the video of me convalescing with what is definitely a flu. It's not COVID, thank God, but I'm pretty knocked out. So you can take it. I will cast my votes.
Sounds good. We hope you feel better. So we'll go ahead and call the April 21st. April 21st meeting of the Executive Committee of the Airport Authority to order. Sylvette, can you call the roll, please?
Yes, sir. So we have Matt Turk, John Hayes.
Here.
Mike Stershik.
Here.
Tara Zirinsky.
Here.
We have a full
Okay,
house?
great. Full house, fantastic. Any public comment today?
No, sir.
Okay. Next on the agenda, we have two action items. First is approval of two sets of minutes. We have the minutes from the March 24th meeting and the minutes from the February 24 meeting. Do we need to do these separately, Tom, or can we do these as one
I
motion?
think you can do it as one.
Okay. I'd entertain a motion to approve the minutes.
So moved.
Second?
Sure.
Okay, second by Matt. Any additions, deletions, corrections, or discussion on the minutes? Hearing none, all those in favor of the subject motion indicate by saying aye.
Aye.
Opposed? Motion carries. Next is approval of the Florio Perucci invoice for, are we doing just one? Because we did last month's at board.
We did.
Okay, so we just have the March invoice for approval. I'd entertain a motion to approve.
So moved.
Motion by Matt.
Second.
Second by Mike. Any discussion on the invoice? Hearing none, all those in favor of the subject motion indicate by saying aye.
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 Opposed?
Aye.
Motion carried. Next is a nominating committee update. We've got both Larry here. Larry, good to see you. Hope you're feeling better.
I am, thank you very much.
Okay, good to hear. And we've had, I know Mike's been involved as well. So Larry, I'll turn it over to you as chair, and you and Mike can tag team as appropriate.
I'll give you the list of folks that have been nominated. For chair, John Hayes, vice chair, Glenn Friedman, secretary, treasurer, Justin, welcome Justin.
Thank you.
Northampton County rep, Tara, Lehigh County rep, Mike Stursik. So those are the people we'll put on the slate for next Tuesday, I guess.
Sounds good. Mike, anything you want to add? I know you've been involved in this as well.
No need. Larry covered it well.
Okay, thank you.
Can you repeat, can you repeat that slate,
Yes.
please?
John Hayes, chair, Glenn Reedman, vice chair, Justin Grimshaw, secretary treasurer, Northampton County Representative Tara, Lehigh County Representative Mike Stursik. And I want to
Okay,
thank,
good, thank you.
I want to thank Mike and Frank for helping out. These guys pitched in. I called them, said, hey, I'm down for the count, and they picked up the ball. So thank you very much, guys. Greatly appreciated.
Yep, good team effort.
Our
Thank you.
pleasure.
Yep. Do we have any discussion on the nominating committee recommendations? Okay, they'll go then to the full board next week for approval.
That's right.
Okay, sounds good. Thank you. Do we have any new business to bring before the committee today? Okay, none. Do we have a need for an executive session? I don't believe we do.
Not at this end, Judge. Is there any need for exec session from your perspective?
No, I have no need for an executive session. Thank you.
Sounds good. I'd entertain a motion to adjourn.
No moved.
Okay, we're done.
Second.
Matt, I think I beat your record.
Wow. That's really quick.
Okay, then we can roll right into the ad hoc committee. I don't think we need a break. We'll go ahead and call that to order. So then can you call the roll, please?
Matt Turk, I believe he signed off. He just got on for
Exactly.
action item.
Okay.
John Hayes.
Here.
Paul Anthony.
Here.
Robert Brooks.
Here.
Dawn Gottschall. She was on
Yeah, I
there.
saw her picture up there.
So form.
Yeah, we only have one action item today anyway, so that's good. So any public comment before we
No,
move
sir.
forward? Okay, only action item on the agenda today is approval of the March 24 minutes.
Moved.
Motion by Paul, second.
Second.
Second by Robert. Any additions, deletions, corrections, or discussion? Hearing none, all those in favor of the subject motion indicate by saying aye.
Aye.
Opposed? Motion carries. Okay. Ryan, you're back.
Back.
We see steel. We see a lot.
Lots of steel, yep. All right, thank you, John.
He
Yes,
wouldn't allow us to have a window here, Paul, because he was afraid we'd spend the whole meetings just watching the construction. And he's probably
Looking at the
right.
top floor there, and,
Yeah.
you know, just see what's going on.
Yeah. Well, Todd and Paul can look out. We can't.
Right. Todd can see too.
So I'll go through some other photos of what you can't see, but just some highlights where we are, about 39% complete right now, day 287 of 730. A lot of the items that are ongoing are the same as last month, they're just in different sequences or phases, as you'll see with some of the photos. But again, you'll see the structural steel was up, they're just doing a lot of the wall formations, steel decking, still some waterproofing, the vertical circulation core, escalator, elevator pit formation you'll see here in a little bit. Really what's upcoming, again, same as before, the biggest thing is later this month, if not early May, the vertical circulation structural steel will start going up, so the crane will come back, which was here for the first section, and then continuing the steel roof decking on that portion of the project. Here's basically where we were yesterday afternoon. Kind of see again some of the walls going up, steel decking on top there. And then from the other side, we actually had to move the camera because of where the building is now, but you can see from the other side basically that shell that they've done, and then continuing to frame it, which is great to see. Again, some more shots, some of the wall supports there. Inside, again, still doing a lot of the work in there. Just more shots of the steel decking. Again, another one. This is actually basically where the TSA support space offices are going to be, and then that area on top is basically the almost like a landing above the office area. So last month, I think you saw a lot of the actual foundation formation. You can kind of see on the left there the actual supports. So that obviously has been worked on since last month. You can see kind of where we are. Some of the escalator elevator pits working there still with the formation. The area, the tunnel that was broken into, just doing some of the cleanup and area required there. Again, another larger shot, but you can see kind of the curve on the bottom. Basically on the left is where the elevators are going to be. Just to the right where that yellow piece of equipment is where the escalators are going to be as part of that vertical circulation core. Again, just some more shots in the pit with some of the steel support foundations from the micropiles in that area. Again, also starting to run some of the conduit. You can see running through the space under and through the tunnel in some of those areas. Again, some of the other waterproofing on the left is our existing tunnel, and some of the other pits and areas. You can just see some photos there. So really, in terms of where we are in terms of phase one, kind of see which items we've completed. Still working on some of the foundations over in the vertical circulation core. Still working on constructing that and waterproofing the existing tunnel. It's really where we are with some of the items we've seen before. You can see the difference from March to today. Again, about 39% complete. But you can see the different, the building shell is probably the biggest one that we've seen physically. And you can see the percentage of it continuing to move forward. Yeah, in terms of phase two, we reworded some of the elements just based on where they are now, but really it's what you kind of see happening now, completing the steel work in the building shell, reconstructing the pavement around once all the site work's done, commissioning the new checkpoint, commissioning the vertical circulation core as part of the project. And then, as we've talked about, is once all that's done, the existing TSA checkpoint is closed, we can then work on the tunnel for the arriving passengers. So really where we are with some of the funding, you can see on the left in terms of the grants that we received. 2 grants right now outstanding, waiting to hear back hopefully in the next few months. The Bureau of Aviation grant for 3.2 we submitted back in December. And then the terminal bill, the bill is the bipartisan infrastructure law funding. That terminal program for $5 million we submitted last month, so waiting to hear hopefully in the next few months on those. But you'll see, made a few adjustments to the scheduled completion dates just in terms of where we're progressing. The date at the end is still the same, but in terms of the structural steel for both the vertical circulation core and the checkpoint is June timeframe, and then the actual shell and doing some of the interior concrete looking to do by August. You can see the other dates there. Just kind of a precursor is, we did talk about this before, is we have been working with the contractors to compress or expedite the schedule, which we did receive, or the design team received one last week that they're evaluating. But really what we're going to do is obviously evaluate that, what the impacts are, any potential cost implications with that, and then we'll come back to the committee to have a conversation about what that actually does to opening the checkpoint sooner than we anticipated, which is obviously what we really want to do to get this thing done. For the passengers, as Todd alluded to, the numbers continue to go up, which we obviously want to get this thing done. We can see the costs again where we are trending, still holding our contingencies as we go, and then obviously just trying to increase that grant funding amount to reduce our share in the end, which is a huge benefit. So I believe that's it. Anyone has any questions?
Any issues with the contractors, supply chain issues, getting equipment?
No, in the beginning, we talked about those concerns with them, and what we did is worked on ordering any materials that they could sooner, if we had to store them here on site. A lot of the long lead items have been ordered months ago, so we haven't run into any issues at this point.
Okay.
Yeah, I think that was our big concern when we jumped in, and it was, what were some of the critical path items and really getting those ordered as quickly as we could. But so far, I think the tables would, we're doing okay.
No, I mean, that's an issue, obviously, but you get those big items ordered. Okay, awesome.
Other questions? Anyone remote, any questions? Okay, Ryan, thank you.
Thank you.
Oh, Tara's got a question. Tara?
Oh, no, I'm good. Thank you so much.
Okay. Okay, does anyone have any new business to bring before the committee today? Okay, I'd entertain a motion to adjourn.
Motion.
We're good to go. Everybody, thank you, appreciate it.
All right,
Thank you.
Yep.
Thank you.